Hey everybody, I wanted to talk about a bit of a difficult topic. Changes possibly at the Fed. We have a lot of talk about removing the current Fed chair and changing some things going on behind the scenes. And I wanted to talk about what we've done in the past that may possibly be looked at going forward, right? So let's talk about our federal debt. This is a big topic for our Federal Reserve for that matter. So I want to talk about back in World War II, 1945. Okay, we owed $259 billion. That was how much debt the United States was in, and that was 114% debt to GDP. And, depending on the exact day of it, you hear numbers that approach that 120 range that we're currently in, right? So the debt to the gross domestic product is a very common measurement. And certainly when you get over 100%, that's something to scream about. This is not a good thing. And through history, that was the only last time that we were that far out of control, right? Right now we are out of control. We have over 120% of our debt to GDP. Okay? Well, look at this. I want to make sure everybody sees this cliff here. Okay, World War II, we hit the peak. Debt to GDP, 259 billion. So then we get to the 70s. I want you to see all the way down here to the 70s. All the way down here. That looks good, right? We're not in debt anymore. Okay, well, debt to GDP, well, that doesn't necessarily say we are out of debt. That means we're responsibly owing, is what that really means. Because guess what? In 1970, we owed $371 billion. That's more than what we owed in World War II. So explain that. How does this chart represent that? I don't get it. Doesn't this big cliff here show that we paid off our debt? And the answer is no. It simply is not factual. It is not true. We did not pay off our debt. That's not how we reduced our debt to GDP. The amount of debt we own is only one part of that equation. So think about this. If our gross domestic product, if we became more productive, but what we owed is the same, well, then our debt to GDP would go down, right? If our economy produced more goods, then we would have a lower ratio of debt to GDP. So a couple things happened back then. They called this yield curve control. It was a neat little trick where the Feds pressured our interest rates low. They kept our interest rates low. Our GDP grew and grew and grew and grew and grew. Now, they did keep our debt in control, at least as compared to today's standards, right? Going from 259 to 371 is different in today's world. Now we talk about trillions of dollars. But this yield curve control heated up our economy. It grew the gross domestic product, but also led to extreme inflation. So what happened in the 70s, interest rates had to rise at some point because inflation, the economy was running so hot, the inflation started going parabolic. That's where the double-digit inflation came from. And then finally, the Feds responded. Once they inflated our debt away, right? They grew to the GDP and they lessened the value of our currency. Both those things make our debt look small. And now all of a sudden, we only have a 35% debt to GDP and we didn't pay off a penny. But what did we go through? Well, we went through lots of inflation to get to that point. So that's important that we understand this, and that is something that is possible. So imagine a different world, okay? We've had interest rates going down and down and down and down and down and down, and then we started seeing inflation. And the Feds responded by raising interest rates, squashing that inflation. We can argue whether we think that works or doesn't work. Bottom line is, at least right now, it shows signs that it worked, and it also showed signs that our economy is more resilient. Our housing is still more resilient. these higher interest rates did not make us fall apart, right? But I want you to imagine a world where they did not raise interest rates. We saw inflation. They artificially continued to leave interest rates low and pressured all of the interest rates to stay low. We continue to run hot. We continue to see more and more and more inflation. And all of a sudden, our debt to GDP starts disappearing. If our dollars aren't worth as much, then what we owe is not that much, right? We have to understand that. And that becomes really important because our history is not necessarily to pay off debt. I am a very fiscally conservative person. I don't like our company or our country debt. But the reality is we don't have a history of paying off. Once we owe, we just continue to owe more. All we want to do is inflate it away. Now, responsibly inflate it away, sure, okay, a little bit at a time, but not parabolic double digits, 10 years worth of inflation to make this debt look small. So we have to know that this is certainly a possibility. I'm not saying it's happening. I'm not saying it's going to happen, but they have talked about yield curve control. And that's what we did back in World War II, at the end of World War II. So we have to be careful about this as somebody or people that live under the US dollar. We have to be careful and understand the effects of inflation, and we have to be prepared. Those that want to continue having, well, there are things you can do in your portfolio to protect against inflation. Okay. And I'm not saying go all in and buy all gold or anything like that. I'm not talking about doomsdayer side of this. I'm saying have a well-rounded portfolio that will help you combat the inflation as it occurs. So I want to talk about the 4 categories that you should have some of your money in, not all. Okay. So diversification. Look, real estate has done fantastic in this inflationary market. Whether it's your own personal residence or rental properties, because think about that, rent has significantly risen in inflation times. So not only does the value of your house rise, but the income that you're receiving from it will go up with inflation as well. So real estate, that's a winner. It's a good thing to have in a bigger portfolio. Then you got things like stocks. Well, yes, you should have your normal stock portfolio. The vast majority of stocks do well with low interest rates, especially the tech world. Definitely want to own tech. S&P 500 does great. Smaller companies do well with lower interest rates. Pretty much all companies do well with low interest rates because in order to grow and expand, you borrow. That's the reality. So we like owning lots of stocks. Then there is commodities. Well, if we see inflation, then the cost of all these commodities goes up. Commodities in general do well. You look at a lot of the funds, when we hit those inflation numbers of 7, 8, 9%, those commodities, investments did much better. So commodities, you could add some of that to your portfolio. And then there, yes, is gold. Okay, gold is an uncorrelated asset to your stocks and bonds. It is a good thing to hold, especially if we go through inflationary period. It has a long history of being a very good inflation hedge, to the point where most of the commodities, ETFs and mutual funds I've looked at do own gold in there because it's a commodity. So the reality is these are all good things. So functionally, for larger portfolios, okay, look, if you need every penny working for you to fund your retirement, yeah, this type of investing, a lot of this, you're not going to go buy, multiple real estate properties and add that to no, that functionally needs to stay a well-rounded portfolio. You can add a little bit of commodities, maybe a REIT instead of owning, more actual physical real estate. You should own some stocks. And yes, in some capacities, you should own some gold. Maybe it's just GLD. Maybe it's just adding what we call paper gold, or maybe hiding some in your closet. I do believe that gold has its place from its investment value. I am not a doomsdayer. It has investment value. It's diversifying your primary currency in case that currency devalues. That's important to understand. Through time, you look at the purchasing power of a US dollar, it has consistently gone down and down and down and down, whereas the purchasing power of an ounce of gold has gone up and up and up and up. It's a diversifier from an investment standpoint and a currency standpoint. Don't go put all your money in gold. Don't buy guns. Don't build your bomb shelter. No, it's from an actual wise investing strategy standpoint that you want to diversify your portfolio with a little bit of gold. Okay. Now, for those of you with larger portfolios, these are people that are able to do long-term positioning for growth. Gold is an absolute must in those types of portfolios. And just like reinvesting your dividend stocks and commodities, you reinvest those dividends, that helps build and grow those portfolios. Earning yield on real estate, meaning rental properties, as opposed to just owning a house that costs you money for upkeep. You rent it out, you make money along the way, and the value goes up. You can actually do that with your gold too. That's what's amazing. People seem to miss that. There are people with larger portfolios that are positioning themselves for long term in gold when you could be earning gold on that gold. You could be earning ounces of gold along the way. And that's so important that we understand that that's available out there. Earning yield on gold is available out there now. The central banks of countries have been lending out and leasing out their gold for decades, eons. Well, now average investors can do that as well. Private companies, jewelry companies, Brinks, the securities company, is actually facilitating a lot of this. Lloyd's of London is ensuring this. It is a legitimate banking industry in gold, because there are so many businesses out there that use gold in their production, whether it's electronics, whether it's jewelry, whether it's even just those mints, those bullion producers that produce coins that aren't governmental coins. There are so many entities, all the mining industries that use gold in their production, and they need to lease and borrow gold for the production of their business. It's smart business in their case, especially some of these smaller mines. Very important for them. So you can earn yield on yield, and that becomes so super important. So if you don't know how to do things like that, if you're interested in how to protect your portfolio from inflation and the devaluing of our currency to shrink our debt, not by paying it off, then give us a call. We're happy to talk about this stuff. I think this is important for those larger portfolios, the people that can long-term position their portfolios. So you can always jump on yourinvestmentcounselor.com and schedule a free meet and greet with myself or Grayson. FPFEAZ.org. That's where we run our nonprofit. You've got full class schedules on there. We do a different topic every month, and those are hour-long classes over Zoom. Phone number, give us a call, 800-345-3155. Like, subscribe, share this video. If you need to know more, contact us. We're always happy to help in that world. Thank you. Have a good one. We'll see you next time.